profit, it knives their pocket directly. So as long as they keep the bare minimum happy, but they are going to go ahead and able to generate more profit for themselves, one. But two, note, banks want to offer more and more lucrative deals to their consumers in order to go ahead and say, you should opt into our bank, because once you have the money, you can go ahead and spend it, which means uniquely they want to provide higher returns on your bank accounts. The way they are able to do this is only by taking riskier and riskier investments, right? So the trade-off in the bullet you're willing to bite is sure on our side of the house, we might have bank accounts that have lower returns on investments, but we're going to argue how this is going to be extremely less risky and why this is important for customers. I'll take it in the fifth minute. Okay, cool. So one, I've talked about how you have an incentive to make this more lucrative for like people wanting to buy into your account, but secondly for your own profit margins as well. Uniquely, when you go ahead and we have the act to prove that you buy more government treasury bonds, you're forced to adopt safer methods. This is incredibly important because banks take way too much risk right now. They fail in a large number of ways. I will talk more about this later, but uniquely we're able to do that now. Where does this money go instead if not into the pockets of these rich bank account people, right? I think this goes into the government because the point at which you buy bonds, government is able to actually utilize this money, and this is incredibly better. Why? Because note, banks are terrible evil actors. The things they do with the money is probably buy properties at property at cheap rates, sell them for sky high amounts, and buy investments for themselves, which are incredibly risky. All of this means one, they fuck over the market, but two, things like housing and all go down because these banks and corporations constantly buy up these, which means if the banks spend this money in a terrible manner. The point at which this money rather goes to the government is able to spend this in a better manner. Note this debate exists in a comparative. Don't let them just say, oh, the government is a bad actor as well. Uniquely, we think that we can hold the government more accountable to the point we can analyze the spending much better, but they also have a responsibility because they want to be voted in again and again to behave in a particular manner, which means they're going to be nicer with the money. They also means they are going to fulfill the agency of individuals, which means if people want the money to be spent in a particular manner, the government uniquely is able to do that. Something that doesn't happen with banking corporations' profit. What this particularly looks like is money being spent on welfare, money being spent on infrastructure, money being spent in order to create more and more jobs for people. This is incredibly important. One, because money is better spent on our side of the house. Secondly, we think government creates long-term value with this money, right? Banks which only have a short-term profit incentive nature want to go ahead and maximize their profits right now, which was why they flip properties for sky-high prices, even if it leads to like bad economy in the longer run. Uniquely, when you create infrastructure and jobs, over the long term, the government is able to produce greater result and greater benefit on the same amount of money. So the amount of return you have is not only that percentage you look at, but future jobs created, and that's the most important thing in this debate. Because uniquely, how this impacts is more people, especially vulnerable communities, are able to access welfare much better. Not only are we helping in scale amounts of people who are helped much better on our side of the house, we also win in terms of accountability. We also win in terms of how this provides is able to help the most vulnerable community in a higher scale, and we're doing much better than opposition already. Yeah.
Governments right now have the capacity to roll bonds over, i.e. they extend the time period in which they need to pay back the bank for the loan. What are the incentives of governments to not just keep on rolling the bond over and not pay it back for the next 15 to 20 years?
Uniquely, I've talked about how governments have to be forced to be responsible, right? The point at which you buy more government bonds, you hold the government accountable. The banks aren't going to just roll over and be like, hey, guess what? Okay, I'll let you go ahead and extend these. The point at which you buy more government treasury bonds, people who are investing money in the banks know you're buying these government treasury bonds. The people who vote for the government are going to vote for the ones who are actually promising returns on their money. They're not just going to roll over. I don't think this is a fair enough argument coming from closing. But secondly, I still think people are going to walk into banking institutions, right? Multiple reasons. One, banks uniquely provide security for your money. You can't just hide it with cash under your pillow, which means you're still going to opt into banking. But secondly, you still need to build up your credit score and other things in order to access other banking services like applying for a loan. All of these which are incredibly important to generate investment, to start a business, to keep your money safe. All of these reasons are why people still opt into banks. So we think people are still going to use banks, and we're going to use our money in a much better way. But lastly, I want to talk about how we're going to prevent the worst case scenario, right? Opposition is going to argue in this debate that, oh, bank crashes never happen. But we don't think this is the case, because any argument they have is going to be purely mitigation. It's proof by fact that banks do collapse the status quo. There are multiple reasons why it's incredibly bad right now and why we have a level of urgency. Note there's a high volatility in the amount of markets in terms of why we have, number one, we have a lot of income disparity, which means the rich people can act on riskier investments because even if they fall, the government has to back them up because they now have become too big to fail, which means the government isn't, like the economy itself is increasingly volatile state. Secondly, this banking incentive to create volatile investments. I've already talked to you about this. What this particularly means is you're not like these banks always want to get more and more profit for themselves, even if it comes to the expense of screwing the market over, which which particularly means that the worst case scenario with these banks default is incredibly high. One. But two, I also talked to you about how we have smaller banks, right? So even if the big banks that are too big to fail might not fail because they have a diversification, these smaller level banks do not have the level of diversification. But the point at which they lose all their money and default, actual people on the ground, especially in these remote areas, are the ones who go ahead and lose their money. We do not want that happening. The point at which we are able to provide safer investments for these people, reducing the probability that these banks default as a point, we think smaller banks will not default as much. Why smaller banks then also defaulting is such bigger problem, right? Note on the comparative, like bigger banks now buy them out. This is particularly helpful because bigger banks tend to be more even. All of the analysis have given above, and they hurt the most marginal community. On the comparative, on our side of the house, government bonds now need to be paid back, which means the government is able to absorb all of these defaulting. I think they do a much better job than profitable banks who will use this money in a perverse manner and use it to buy back all of their profit. We're so happy to propose.
Inviting the leaders of
Hi, Robin Young, leader of opposition, no pronoun preference.
So Robin,
Starting my speech in 3, 2, 1. Two pieces of setup. The first thing is that what is the actual difference on both sides? The primary difference is on our side a lot of normal accounts exist. Then there's a fixed return which is told to a particular person before they're investing. So you'll tell them that you get 10% return if you invest here. But on their side, both accounts exist. There's a normal account which has that fixed return, but also equity accounts which has a fluctuation return. So this means the return can be 4%, like so it can be negative 10%, it can be also positive 10%. So there's a possibility theoretically of losing your investment, there's a possibility of earning much more. So given that it exists on a spectrum. So the first thing I'm going to explain why banks have incentives to push people to use equity accounts on their side. This means there's much more money pushed in those accounts and not in the normal accounts. This is true because of 6 structural reasons. Reason 1, notice that banks have an ability to get more return on investment on these things by virtue of it being actually fluctuation. What this means is that notice that the normal rate of interest that banks get, this means that you can get actually much more interest rate of investment here, primarily because you have an ability to actually put this investment in more riskier investments where the possibility of you actually earning more is much more there. This means it's a benefit to bank and it's also a benefit to people. So because of this incentive, because of ROI, banks push people to go for equity accounts. The second reason is that we think that you are not being forced to back up some cash on their side which exists in status quo. Because the difference is now you're not just backing up cash, you actually can invest all your money in assets if you're actually buying government securities. What this means is you have much more money that can actually be there. The third structural reason is there is more money to play around on their side. This means there is higher lot sizes in IPO that banks can buy. There's more riskier investment by virtue of your ability to use the entire investment or not having a requirement for having 15 to 30% cash as reserves, because now the requirement of reserves has been changed to a government security. The fourth structural reason is that banks have marketing techniques where they influence people, where they send relationship managers, wherein they influence people to actually go for such accounts because banks have perverse incentives for profits, even banks are going to do this. The fifth structural reason is that information is none for the poorest of the poor. When an old woman walks into the bank, the old woman has no idea what's going to happen to their money. It's the bank manager which will tell this old woman that we're going to give you a great return. We think this old woman has no information and therefore is going to agree to whatever this bank manager actually tells. The last structural reason is the perception of banks that society has is that they're very safe institutions. What this means is, and also the entire government's idea about cashless economy, this makes it much more easier for banks to allow people to actually shift towards equity accounts. This means there's much more money being there for equity accounts. The implication of this is that why is all of this bad? The first thing that all of this is bad is that now people invest in more riskier investments without adequate knowledge. This violates agency and choice of people, right? Primarily because people have no idea where this investment investment is going, because there's a theoretical possibility of people's investment actually going bad and people getting negative returns. This literally means vulnerable people have no information at all, literally losing money because the interest rate was fluctuated. This means it can also go negative, right? Now government might say is that this is the same thing as stocks and crypto, where also people don't have information. So what's the difference? So you have to make some sort of distinction. Here are three distinct mechanisms. What is the difference between banks and other risky revenues? The first set of entry barrier is reduced significantly. I think banks have physical locations. You literally enter there, right? Except we think the entry barrier is still relatively more than banks for things like stock and crypto, which are more high risk. The second reason is proximity and trust. Notice that there is no relationship manager in crypto, but banks literally send relationship managers to your house. There is a human-to-human connection. They'll literally use tactics like they'll drink your tea, they'll come to your house, they'll talk about how good your son is doing in that debate tournament, etc., and they'll convince you that this is the best thing that you can actually do. The third structural reason is the one that I mentioned before, how banks since time immemorial has been seen as rigid institutions, has been seen with a history of trust. All of this means is that the degree of choice and the easier manipulation can happen is actually much more. What this means is, and on the scale of vulnerability, we think this is a violation of choice of people who have literally no idea that their investment can literally go bad. The next thing I want to explain is that why banks are likely going to use this money in riskier ways, which actually impacts the entire argument that the reason that the money can actually go bad. The first structural reason is because of competition. Because banks have tons of competition, there are incentives to maximize the returns. What this means is that you have incentives to actually go for more riskier investments because you have to out.
Can you please stop? I need to throw up.
All right. Can someone tell me what's the time?
4:37.
4:37 I stopped, right?
Gave a banks will use it on more riskier basis because of competition. Moving on to the second reason. The second reason is that when you see the trajectory of banks, the profits that banks have been making have been reduced over time. The reason for this is how the younger stakeholders have moved towards stocks and more riskier investments. This means that banks are probably quite desperate. That is the reason why they actually want to do this. The third structural reason is that banks are bought by bigger companies with literally tons of money, big conglomerates. What this means is that even in the event of loss, where this money goes bad, then they can offset this by other investments because they're not as vulnerable as the old women who walks into the bank to begin with. I think the conclusion of this then becomes is that the possibility of money actually going bad, literally people having no information about it, is actually quite high. And I think if you talk about the likelihood of crashes, we think that opening government themselves explain how markets are so volatile. This means they literally they literally proved our case by explaining because the likelihood of crashes is actually so high. This means that a lot of money can actually go bad. The weighing of this argument is that even if some banks get positive returns by riskier investments, we think all it takes is one bank to get negative returns, and we think the harms to those people is actually at its maximum. So we think that it hurts the most vulnerable people, and that is something that we do not want. Now I'm going to explain why is the comparative much better. Closing.
Equity accounts not only allow you to invest elsewhere, but they have to backed up fully by government bought safe assets. In normal accounts, you have a ratio which is significantly less. Engage with the risk.
Alright, I'll do that. Why is the comparative better? The first thing to explain is that we envision banks to be the safe haven for people. Risk appetite for people is starkly different and is starkly subjective. Every particular person is different. We think banks are institutions for people whose risk appetite is less, otherwise they would have moved.
Stop.
As I was explaining the comparative, we envision banks to be the safe haven for people because risk appetite is very subjective. We think banks are institutions for people whose risk appetite is less and they don't want riskier investments. We think that banks use this as a tactic to actually go for more riskier investments, which is bad for the most vulnerable. Now to answer the POI that we received, we think the first mechanism is literally what POI was asked because that is to say is that governments have incentive to delay the maturity time. But number two, the minimum maturity time for government bonds is also 91 days. What this means is that we think in times of crisis, in the worst times where people need money the most, for example, when it's literally things like they have to pay hospital bills, etc., we think you can also have situations such as bank run where they literally don't have liquid cash because on status quo there's a 15 to 30% requirement in terms of you actually keeping liquid cash, except now the requirement changes because you can use 100% of money that you actually get from people and use it as a government backed security, right? Because they're not as liquid as money, we think that's generally bad. Lastly, 5 seconds left, we think the end thing that we want to explain is to suggest is that we don't want banks to go for riskier investments because it harms the most vulnerable, and we think opening opposition cares for the most vulnerable. Thank you.
Tell you about this is the people I was talking about in this very ambiguous short term.
Love all of you. But thank you so much, the entire crowd being here. Lovely, lovely people I'm debating against. Always fun debating with people you know and love. Yeah, that's everything. I will now skip to the speech. Perfect. I will start my speech in 3. Really quickly, understanding the fundamental push from OG. If corporate fat cats and banking were making their money off depredations of people get skinnier, we don't mind those felines being skinnier. Because this money now goes to governments. As for all of the idea in terms of people being dumb, or people will now be pushed by banks to make riskier investments, all of that is taken care of by status quo anyway. Because banks, guess what, don't just have accounts. They do things like predatory pricing, like have demat accounts, like push credit cards, like push loans, like push management in terms of going ahead and investing in stocks and all of that. All of the harms that they talk about exist with banks anyway, that's going to exist anyway. Why then do people not quite so often fall for those scams, and mitigation is engagement I will deal with. Really quickly, dealing with the POI that you get from CO and why it's absurd. Understand situations in which bonds are rolled over. Bonds getting rolled over is a massive hit that countries have to take that diminish their international reputation, and it goes really bad for the country's indicators of economy, which is a bad signal for anyone. It is done in extremely exceptional circumstances when there is massive recession only and the government literally cannot take their eye off the ball and only do it in those situations. Situations where everything is going to hell in the handbasket for these people. I'm telling you, these are not the situations you hang them in. Hold on. Specifically then, even in those situations when it's getting to recession, these are the last people to default because they are the safer and most likely in terms of having safer investments and the government coffers to invest and go ahead and recur by, which means they're the safer. Second, understand and put this in context. Gut check this. How often are sovereign bonds being rejected when you try to sell them? How often does it happen that you don't get those bonds? In terms of the 91-day limit, understand why that's also factually untrue, because that only happens for specific types of bonds, not all types of government bonds. The government bonds and various treasury bonds exist on a spectrum. Central bank treasury bonds exist literally in instantaneous ways for banking institutions because it's a part of regulatory things that the central bank of nations have to do for most stable, reasonably even developing countries in the world. Clearing this impact because it's absurd. Try to run it as a debate breaker. Quick weighing in terms of why increased government spending and why vulnerable groups are better off in their world, why this is the biggest impact, because none of it is engaged so far with opening opposition. I'll take you eventually, don't need to. Cool. 1. The obligations owed to the people is the greatest. This is a principal push they get no response from. Fundamentally saying that the state, one, has the ability to do so in terms of making laws. For example, banking is still going to exist, but you can make laws that regulate banking, simple gut push. Alcohol as an analogy, you're not allowed to sell alcohol by the highways. You can restrict how industries function. This is a principal push. They still have to deal with that as to why this is a fundamentally principally backed and justified model as to how you're going to regulate banks. Second, obligations owed to the people, which fundamentally means that the state responds to what people decide and the state is allowed to make laws based on what is going to get more benefits to the people. At which point, even if, of course, they can give ideas as to why government spending can be bad, but we tell you that's going to be bad based on whoever your government is. That's not on clash in this debate. At which point, increasing government coffers increases government's capacity to do welfare, things like that, which help the most vulnerable groups. Why are these vulnerable groups the most important? Inherent pain, but uniquely also telling and engaging with Rohan's analysis as to why we uniquely prevent worst case scenarios. Worst case scenarios are bank runs or banks being unable to go ahead and give the money that they are owed because of bad investments that they've made, or because they run out of money, or because they can't go ahead and compensate for the run when everyone wants their money back. Uniquely, these situations happen often only with small banks. It doesn't happen often in general anyway. Therefore, this is a worst case scenario that doesn't happen very often. But uniquely, why is this an exclusive harm to their world and why is it the big bad in this? Because the latency period between this specific crisis for a small bank suffers the demographic that Rohan told about, which is uniquely rural people, people who don't have access to other banks, people who have access only to smaller banks and smaller name brands. Uniquely, in this latency period, while this crisis is resolved, they have nowhere to go to. These are also people with the least amount of financial literacy in terms of understanding that they must divest their resources in different banks, which means their life is essentially screwed over in this interim period in this crisis. Exclusively then, this situation becomes far less likely in terms of these crises going down, because bank bonds, if backed by government, means that they get this instantly or get this in a more secure way. Therefore, these smaller banks would have this far less likely to occur in the first place. Dealing with structural reasons are actually reasons that mean the structure changes in some way, not just arguments. All three structural reasons in terms of why banks push people and go ahead and continue to influence them, like I told you, happens anyway. But second, people are risk averse. Why do we have to convince people, and why do you see ads about mutual funds and equity funds, however risk investment or stable they are compared to the stock market is? Because people don't know. They want the safest thing. If they could get away with it, they would hide their cash under the mattress, and that's the problem, right? This largely means even in the most developed of countries like America, like UK, like Finland or Sweden, people are risk averse, they want the most stable thing. People in America, the richest of people, dump it in a 401k and want that money once they're retiring because they don't want to deal with these shocks and need this reliability. Second, this changes the cash reserve ratios and stuff like that. We have fiat to make our model. No, we're not going to change the cash reserve ratios. I don't know why that's a structural change they can make. Third, lots of IPOs and monies and banks are now going to spend money. Where are banks getting all of this money from? Banks can only do it in certain ways based on the money they get. If they have to do it by model based on government-backed securities, I will take that POI. Go ahead.
Are government bonds always safer for banks to invest in?
Yes. Moving on to my case. Until you prove otherwise, yes. Why reduced entry barrier and increased proximity and trust? This argument that you get, which means opening opposition says banks will now be more easy to con people. Understand that happens in status quo, like I said in my intro anyway. But second, understand who this happens to. The average poor person doesn't get the Dalal and Brocha relationship manager. It happens to some of our privileged dads and moms who do this. This doesn't happen in terms of relationship managers conning you for every average citizen. It is largely understanding of what these people do and what these people choose to invest their money in. Once again, characterization that they're risk averse to where they are likely to is therefore more competitive frame and more relevant in this terms of understanding. Really quickly then lastly, understanding as to why these governments will now use this money better. Like we've already said, there are structural reasons which have gone so unengaged as to why these governments use this money well that you can get from Rohan's speech. Insulating it from potential or preemption that we can get from opening opposition or closing opposition. This is likely to be done in good ways because governments are far more accountable in public spaces and have incentives to be pulled back by the people, and regardless of whether it's good or bad, if people want war, people get war, people want welfare, they get welfare. Which point inherently it's a good thing when governments have more spending to be, they can do it, increases their capacity to do better, versus the idea of corporate fat cats getting fatter, where banking systems are still going to exist. So on balance, they're still going to be fat, but uniquely now, supernormal profits get diverted to the government, which is better spending and the world a better place, which is why we give this debate to opening up.
You can start.
Okay. Hi, Krishan Kohli, him, DLO, POS, however, whenever. One shout out, Robin Ahuja, Real G. Moving on. Starting speech. 3, 2, 1, go. First thing that's really important to do in this speech is to actually clear out what the binary of this debate is, because I think even the closing benches seem to get it confusing. 4 things in this speech then. First, binary. 2, thought experiment. 3, mitigation. 4, way. What is the actual binary of this debate? In status quo, there is only one type of bank account. These banks may operate other financial institutions, but there's only real one type of bank account that exists. What does this have? When you deposit money into this bank account, you're guaranteed a fixed rate of interest that they may change year after year based on other stuff, but when you deposit, you're promised a fixed rate of interest for a certain period of time. Deposits can be split up into things like state securities, into debt, into cash, into equity, etc., etc. Now, we have 2 different accounts that these banks are able to push. Both of these are bank accounts. These are not just separate financial like instruments. These are not the same things as demat accounts. I'll like explain that a little bit later. But one, you have like the relatively safe accounts which have to be 100% backed by like government securities, and two, you have the equity accounts that are to be backed by like banks can use to basically invest however the fuck they want to. That's the actual binary of this debate, which means that you can't model that, hey, we're just going to have like cash reserves, etc., because that's fundamentally the burden of the motion. I asked that in clarification, but even if you do, we'll still try to beat you on that. Secondly, thought experiment about what Robin's case actually is, because I think the larger case. I'm walking down a lane, I'm an old person, and I have 100 rupees in my pocket. I want to increase my money for a variety of reasons, because I am no longer productive, because I no longer have the physical ability to go ahead and work, because the cost of living is rising beyond my means, and I actually want to at least not just keep my money in a gulla, but get some degree of like interest on it, so I can make some degree of money. While I'm walking down this lane, I can come across two types of people. One type of person is probably this like joint smoking hipster with an iPhone 14 and shades and stuff, and like who comes and tells me that, hey, you should probably invest with me and I'll be able to like get you millions and millions of dollars, etc., etc. I probably don't opt into the Zerothas of the world. I don't opt into the Upstoxes or the Coin DCXs of the world, because even though they may be flashy, even though they promise me higher returns, they don't have the unique characteristics that banks have offered me and my family for entire generations. I think these are too technical. I think these are too risky. I think that these are things that are only for young people and they're not catered to my particular demographic. The other sort of person that I can then encounter is an old family friend. Now this is a friend who just tells me, hey, you give me 100 rupees, I'll give you like 105 rupees next year, all sorted, and if you want your money in the middle, you can just come and take it from me. I know this person, I trust this person, my father trusts this person, and like my entire like generations and generations of my family have trusted this person. What I don't know, and this conceded by all sides of this debate, is that this person is also secretly evil. What this person wants to do is to maximize their ability to like make as much money as possible. What is stopping them from doing this in status quo? In status quo, what can they push upon me? They can either make me buy a opt into a default bank account where they have to comply with restrictions and have to have some money in cash, some in spending, some this, some that, yada yada yada. So they can't just claim to be like Upstoxes of the world, etc., etc. If they do, they will push to me a different demat account and they will lose a large degree of the trust there, because I perceive all demat accounts to be like equally largely complicated and technical. I will have to like individually choose stocks. I'll have to keep up with the news, etc., etc. These are various factors of stock investment that come in. That does not happen in the equity bank accounts that we are talking about in this motion. In this motion, you pay money. After a time, you either get interest in the positive or you like get less interest than you were promised. In the worst case, you go to zero or you get negative interest. That's how this debate has to function. So, if this family friend has an incentive to fuck me over, but in status quo they are unable to fuck me over to their maximum capacity because they know that they will lose trust when they force me to make like complicated sorts of transactions and force me to like keep opting into like and exercising my agency and keep having to be updated with the news and making all sorts of technical transactions and selling orders and blah blah blah, whatever you have to do on a demat account.
In status quo, if I put 5,000 rupees in a state bank account, do you not think that 5,000 rupees is being lent out?
I don't think that's relevant. Yeah, sure, it is, but that 5,000 rupees is being lent out by the binary that I established, and that's different from what we're talking about. Okay, moving on. I think that this, what GovBench here is largely allowing these banks to do is to bypass these restrictions, is to bypass these technicalities, is to bypass all sorts of things that prevent the banks from fucking you over and making maximum amount of money possible, and to be able to sell you a demat account under the guise of an equity account, to sell you, to force you to like make sorts of equity transactions under the guise of a default bank account, where they get to use all incentives of a default bank account, but they get to get all the benefits of an equity account that they would ever possibly get. That's what this debate is about. Weighing them, I think that what OG largely talks about in this debate, and okay, if
you're that financially illiterate, you don't know the difference between demat and bank account, and you'll be scammed by your trust regardless. This is incredibly symmetric.
No, it's not about financial illiteracy with regards to whether you know the difference between demat and bank accounts. It's about the relationship managers that exist that are able to tell you that, hey, you know what, this is largely the same thing as a regular bank account. You will get your interest, etc., etc. Trust me, you'll eventually get it. You won't have to dimag khapao yourself into this. I'll handle everything everything for you. I'll do everything. Don't worry about it. It's just like a regular bank account. Most likely it will be successful. A demat account involves lots of technicalities. A demat account involves active involvement from the person who is there to monitor their transactions, to monitor calls, buying and selling, etc. etc. Weighing versus OG. I think that largely, I think if people want to run younger people in closing half, I don't think they're super relevant because younger people get counter narratives from all sides. Their family tells them bank accounts and FDs are safe. Instagram tells them that, oh, it's zero high school and they find these things in school, which means younger people potentially probably make like most rational decisions for themselves. I think the main stakeholder here who are actually being uniquely affected by this motion, and here's where we way over opening government, are these older people. Because note, what OG's entire claim rests upon is to like amplify states funding, spending, and to be able to spend more, like allow the state to spend more money and get more projects and to give out more welfare, etc. etc. I can give you like a million reasons why states are likely to be inefficient, in developing countries states are likely to be malicious, etc. etc. I don't think that's necessary. I can take them at their best case. Say states are perfect. I don't know why this is the unique mechanism that we are using here to amplify state spending and why this becomes the winning metric of this debate. I can think of 10,000 other ways to like give the state more money. The state actively goes ahead and calls for like puts out debentures, especially even short-term debentures and stuff, to just make more money for themselves and they're spending in the short term whenever they need it. The state has access to all sorts of different loan-taking platforms where they can get money from. The only unique impact of this debate is on older people, is on people who are somewhat financially illiterate, people who put their lives and their money in the hands of the banks, and these banks fuck them over. Very proud to
Thank you, Speaker, for that speech. Inviting member of government to extend the
I will take my WTC minute. Couple of shoutouts, one to Vijay for being an awesome teammate to actually come here, and to my regular teammate who is not necessarily known in the circuit, which have realized recently, Naitara, and my juniors who patiently waited. Starting my speech. Also, like, I really like RB as a comp, that's why I wanted to come here. And last year I was sitting there impotently as a judge. I want to speak in the finals. Now I have. Thank you. Starting my speech in 3, 2, 1. Look, OG misses out a huge word in this debate, which is to prove why the government having more money is a good thing in the first place. Not all the impact often times, and why government having more money is good. You get better policy, they impact minorities. All of that is contingent on the fact that you can prove that government is using the money better. I'm not sure why governments are likely to enact policy effectively. They're riddled with bureaucracy, corruption, I don't know. But at the same time, I'm not sure why banks are necessarily evil, right? They help me get to school, they help my parents get a house, they also help my uncle get a loan to start his businesses. All of these are good things for the economy. I think then, what exactly are we going to fill here, right? We think banks are not evil. We don't think banks are not evil. We don't think government is necessarily the best person to do this. We're going to tell you that specifically when you enact this policy, there's going to be a change in the way banks interact with loans, and that is necessarily going to be helpful for the economy. That's actually what the debate should have been about. I'm going to take opening up out of this debate, just explaining what banking is in status quo. One, if you have deposits, this is in the info slide, if you have deposits, you can necessarily put the deposits into loans right now. That is how banks make money, Jesus. But the second thing here is that the equity accounts right now is that if you have X amount of money that a bank can use, I could potentially lend and give this money. What changes now is that if I have X amount of money I need to give, I need to put X by 2 money I can give loan out to, and then X by 2 money should necessarily be in government bonds. What does this mean then, right? I have lesser amount of money I could potentially lend. What that necessarily means that that means we're going to posit that this means like lesser financial risk. What do I mean by this? If I have X by 2 amount of money I can give, I'm backing that by X by 2 amount of money. That means I'm going to be less risky, and why this is I'm going to do that in like 2 ways, right? One, I want to posit that you're less risky when you don't have enough money. I have 100 rupees right now, which means I'm unlikely to spend that 100 rupee in poker. But if I have 10,000 rupee right now, I'm likely to bet it on higher bet it on higher things, right? This is exactly what the way same banks work. If I have 10,000 crores of deposits I can potentially risk a lot of money because I don't necessarily have to give them back. I can go bankrupt. But then right now, I can only have 5,000 crores. That 5,000 crores is backed by something, which means if the bond goes default, I have to necessarily pay it back by the government bond, which means the bank loses out the money. What does this mean by decision making calculus? I want you to note how many times you've gotten a call from HDFC Bank saying that you're eligible for a home loan, you're eligible for a car loan or whatnot, right? I think these are the things that you go ahead and give unnecessary money and you pump unnecessary money into the market just because you can make a lot of money by the virtue of people like getting more loans. I think this becomes incredibly problematic for people as such. But then secondly, I also want you to note that this money, secondly, I also want you to note that at one time it is backed by government securities. You're going to change the way you give the loans out. What do I mean by this? I'm not going to give CC rated loans. CC rated loans are loans which are like high risky, but I'm likely to give a more AA rated loan or AB rated loan. Why is this true? I want my money back. If I don't get my money back, I can't go bankrupt because the government bonds are always fail secure, which means I necessarily am going to give money to people with AA rated or AB rated. What is this? Why is this very important? This means the people who actually are going to be helpful, in the sense they can go and make, they're able to go and build a house or go and get an education in IIT, are likely to go and get the money as such, right? I think that's when less risky, and the things that are necessarily going to improve the economy, that they are going to likely get it. The second thing then, on the trade-off here is simple, right? Who are not likely to get this money? The people who are risky, the people who don't necessarily have a good credit score are going to be like, they can't because the bank just doesn't have money to lend to you. Simple. I think this is where unnecessary lending is more important in this debate because they don't necessarily prove to you why government having more money is important. But then I'm going to fill in the link right now and take that. Why? Why do you think government need more money right now? There are like 3 structural reasons for this. One, you spent a significant amount of money in COVID, and like in terms of giving out subsidy to people, like building hospitals and whatnot. Because you don't necessarily have money right now. But then in terms of financial recession also, right? You're like you don't have enough investment to like trigger financial recession right now. And then secondly, insofar as government gets more money, you're likely to you as a government are likely to spend this in very, very important things like minority, trying to impact policies. But then you're likely to do it in a better way because government bonds need not to be paid right away, which means you're able to get more inflow of money, but you're able to make this system more secure, which means you're able to bring in more investors at a point in time when you show that your banking system is secure, and a situation like SVB will never happen in our country, where you don't have to have the risk as such. But then more importantly, right, in terms of startups and valuations of startup and why that is very, very important in this debate, I want you to note that the most important metric in this debate, the things that make a bank go bankrupt, things like Nirav Modi, things like putting your money in startups like Byju's, where you don't even take the amount of effort or time as a bank to think about what are the risks associated to it. Why do you do this? I have a shit ton of money. I don't fucking care where I put it. But on the counterfactual, what happens is I have less amount of money. So where do you prioritize money where you can potentially get it? Because if this 5,000 crores are given to Byju's, means that you have to give it back to taxpayers by the government backed bonds. I think that is when you are unlikely to give startups right away. Startups valuation being incredibly high has a lot of impacts on economics. I'm going to extend that, and this is an independent path to victory. Before that, Trishango.
Your entire case is contingent on banks having less money to lend. You need to prove 2 things. 1, why do people asymmetrically opt into safe accounts? And B, why banks make less risky risky investments.
Listen, you don't understand banking. It's given an info slide that deposits can be used to do this. How do you think the fixed deposit rate works, and how do you think they give the money? They just keep it in a vault and give it back to you after 5% rate or what? But then here's more important, right? The valuation is important because when you put a lot of money as an economy into a company like Byju's and it fails, that's when you have investor flight, right? I think that's when when government has to come and bail you out without for all the actions that the bank took, that they don't necessarily look into what exactly is the risk of say Byju's as such. But then secondly, in terms of people getting jobs, right? You give a lot of money to these people and they build startups that go bankrupt in 2 years, which means that they've spent a lot of money which they're not able to actualize into something productive into the economy. I think then on the comparative, we're able to prove to you, when you give it to AA rated or AB rated people, you're able to actually go out and do these things, right? You're able to set up the rural practice of bringing a dairy storage thingy or whatever. I think then they're also able to prove that this money is unnecessarily not like taxpayer money is not unnecessarily given to like banks valuations of startups and whatnot. But on the counterculture is very important. Insofar as valuations of startups become very important, all these like fuck all startups are going to go to angel investors. But then like more important and like very structural startups which can like completely change the industry are going to go to banks, which this is important. I think that is where we are able to change the delta. So proud to propose.
I thank the speaker for that speech. Speakers, please be mindful of the kind of tone that you're using. With that, I invite the members of the
Okay, before I start, I just wanted to shout out God for making Topaz scared of finance debates. I am starting in 3, 2, 1, go. On CO, we have two levels of extension. Firstly, why these banks will have a cash crunch, and that fundamentally leads to a credit crunch for the vast majority of people because supply and demand exists. But also why fundamentally this government spending will fundamentally lead to financial crises because governments will just keep issuing bonds to finance their spending, and it leads to a lack of fiscal responsibility. And I'll tell you why government spending is bad in that regard. Firstly, let's deal with the banks who have a cash crunch. What are the characteristics of government bonds which no team till now has told you about? 4 characteristics. Firstly, they have a principal, but they give you an interest rate return at the end of a yield period. What that means is they're significantly more illiquid in that you take the entirety of the thing at once, like at the end of 30 years or 20 years or 5 years, depending on the yield of the bond, but you don't get interest on a yearly basis. Secondly, note, they have very low interest rates simply because they are so safe, right? Because people trust the government, people assume the government will always be credit worthy. The interest rates on these are 2%, 3%. Thirdly, often the interest rates are less than inflation. Particularly inflation is very high right now because of the COVID stimulus, because of Russia, Ukraine and so on. That is often more than the yield in the first place. Fourthly, the government can roll over these bonds unilaterally. Yes, China tells you it's rare, but the US government nearly defaulted on paying its debts just a month ago. If they hadn't raised the debt ceiling, that would have happened. Countries like Zimbabwe, countries like Greece, they were not able to pay their bonds and they went into financial crisis. What that means is, because they have so much power, because of the literal government, you cannot enforce things against them. You can't take them to international court. All they do is file for insolvency. All they do is ask you for haircuts. We agree. So this means that fundamentally, the government bonds that their side will have put like most people's money in will give very little return to investors. But I'll also tell you why not a lot of people will invest in equity accounts. Opening opposition tell you banks are going to pressure people, vulnerable people into entering them. I'll tell you why these people will never opt into it and the number of equity accounts will be very, very less. 3 reasons. One, there are 2 different types of people I would say. First, people who are risk averse. Your grandmas, your people who are not used to these kinds of financial investments. They don't want to risk too much with their money. They want to be able to do stable financial planning. That as long as I get 2% a year for like 3-4 years, I will be happy. I will be able to sort my finances out. Secondly, there are younger people. There are people who want to invest. People who think they can actually make a lot of money off the stock market. We think these are the kinds of they think that they can actually invest better than the bank. They think that they have a cognitive bias that actually my my investments will be much better, and therefore why should I trust my money with the bank when I can do it myself? Thirdly, on that side, also the government signaling effect, i.e., the government is saying that you can't trust the banks with your money, which is why we're imposing a narrow banking regulation, which means even less people will open up these risky accounts which have like unlimited yield or whatever. That means the high return accounts are mostly gone, while the low return accounts, the government bonds, give you very, very fucking less money. We think that banks' margins will thus be razor thin. That means that they will be able to pay lesser interest rates to people who are putting their deposits in. That means these people won't get enough money. That means that they'll stop putting money in, right? If like I'm not getting enough returns by putting in a deposit, why will I put my money in the bank? I'd rather keep my mattress, in Chinmaya's words. That means there's a massive credit crunch. The supply of loanable funds was massively down. What is the impact of that? Three impacts. Firstly, these banks will charge much higher interest rates on loans. Simply because the amount of money they have is so scarce, they'll charge much higher interest rates to everyone. That means anyone who's taking a loan will have to pay so much more back on their home, car or whatever. That means common people have far less money. But it also means startups and small businesses can't borrow as much because they'll have to pay so much more in interest. Secondly, it means that a lot of people are likely to default on paying these interests. The subprime mortgage crash in 2008 happened this way because people simply could not pay back their interest. We're not making the most extreme case that they all default. We're seeing that your enforcement costs will go massively up against litigating against all these people. We think at various points, banks will have to file during insolvency during periods when the market is down, when people are unable to pay. That's terrible. Lastly, we think they won't expand credit facilities to rural areas and poor areas. Unlike what CG will have you tell you, poor people are significantly more risky to lend to because you don't know they'll be able to pay you back. They don't have credit scores, their credit scores are so low. That means that you think they can't take the risk, that they'll default. So now normal people or the poor people in rural areas will never get access to banking facilities. They'll have to rely on loan sharks, they'll have to rely on money lenders like they do currently. On our side, even though these people can't pay you interest, you trust yourself to invest this money wisely. That means you allow them to open up zero balance accounts and so on. What is the counterfactual? OJ has this absurd case that banks will likely take a lot of risks. I have 4 reasons why they won't. Firstly, shareholders. If you keep taking risky things and keep losing them, they will fire you, right? These shareholders don't expect 100% profits. They want stable dividends over a period of time. That means you're more likely to invest in blue chip companies like Apple or Google or vetted startups. Secondly, notice when there are banking licenses, the government does audits to make sure you don't have too many non-performing assets. After the 2008 financial crisis, like the Volcker rule was introduced, there was stress testing requirements, investment banks and other banks were separated. Also because of media attention, fundamentally, you simply won't be allowed to keep banking if you keep losing people's money. Look at what happened in Silicon Valley Bank. The government stepped in and like prevented further decline. Thirdly, they often buy futures contracts to prop up their risks because they have so much money that is at risk. Fourthly, they have unique market intelligence because of the conglomeration of the best investors, the best analysts, and the best researchers. That means they're likely to make solid bets which will give you a good amount of money. The customers get more money on our side. But secondly, by means of financial crisis. On that side of the house, whatever money there is, the bank has to keep buying government bonds. The government gets the ability to have unlimited budget deficits. Whenever they go about tax revenue, they can issue bonds and banks have to buy them. Developed countries without developed tax bases, which are a lot of people below poverty line, where a lot of people evade the tax and have low tax incomes, they will rely on actually keep issuing these bonds. But also like countries in election years, countries in times of crisis, countries in times of war will issue these bonds. What is the problem with that? Firstly, massive amounts of inflation which raises the prices for everyone. Secondly, it crowds out private investment. When the government is funding all the projects, your growth potential is severely limited as a private company. Thirdly, it means we also think the nature of the investments are so bad, right? Because they'll give handouts to voters. Even in the US, it looks like kind of wave student debt and so on. It doesn't have sustainable long-term growth, but they just keep getting this money, even though the tax base doesn't expand, even though growth doesn't happen, simply because banks have to keep buying them. We also think government money is significantly more difficult to scrutinize because budgets are massive. It's difficult to go and look at each and every single thing. We think private actors we are neutral to them. At least they spend money better than governments who run up unlimited budget deficits. I'm so proud of this.
I thank the speaker for that speech, inviting government to conclude that document.
speech in 3. I'm going to do a bit of meta before I begin my speech. But first, let's take out 4O. Even if they misunderstand equity accounts, their entire case is based on the premise that banks force people to opt into equity accounts and not normal accounts. Well, we don't have to defend that because the motion info slide reads that all deposits have to be equity accounts and all deposits have to be completely backed up by government-backed safety bonds. So I'm not sure what O's clash is in this debate anyways. Let's start with a couple of responses to closing opposition. And why do we think governments are pretty okay and pretty stable? One, we think that the largest form of revenue that exists, i.e. taxes, are the ones that governments get. In the sense that a large proportion of people pay taxes, these are huge in number, more in revenue than any private institution could get. Secondarily, we think government's failing is an incredibly sharp externality, and CEO even recognizes this. This is not just an externality to common people, this is an externality to the rich people, which means that the people who can come out and rescue you because of the threats of a government failing or defaulting on its bonds are likely to exist, which is why they're safe. But thirdly, let's make this comparative. On our side, we have the literal fucking government. On their side, they have private institutions. And by the way, opening opposition analyzed so well as to why private institutions make such risky decisions. Therefore, we think governments are just inherently safer. Two clashes in this debate. One, who do we think spends better? And secondarily, what do we think we actually need to do and what do we think we actually need to spend on right now? The first thing I'm going to analyze in the second clash is why do we guys actually need this right now? In the sense that why do we need these guys to play safe? One, and a lot of top half actually analyzes this. Market volatility, in the sense of booms and busts and securities and shit. Note that a lot of opening opposition analysis applies here, in the sense as to why banks, even in situations post-COVID, that they may or may not have liquidity, are incentivized to go out and pursue these sharper things in and of itself. Secondarily, is a threat of crashes, which CEO analyzes for us, in the sense that in order for us, if we continue and allow banks to constantly give out and lend this money, we think that it's significantly likely that we're going to have sharp repercussions to these things. Thirdly, central banks are lending out a large amount of money and lowering interest rates. This is how you deal with recessions, and this is why you need to be able to do this now. Where does Sharon's extension come into this? Sharon explains to you that look, governments are not great on all of it, banks are not even an on of it. In the current specific constant, because of all of these factors, it's likely that we want to opt on the err on the side of caution. In the sense that when we have these threats of crashes, in the sense that we have threats of market volatility at recession, we think it's a significantly safer idea for you to reduce the liquidity in the market and allow these banks to be safer in the first place. In the sense that we allow them to take on and give out loans that are specifically being able to get them guarantees and specifically able to stabilize the economy when you need to be able to do this in the first place. We win the second clash clearly. Secondly, let's move on to who makes better decisions and why do we need them to make better decisions. Let's start with OG. I want to note all of the analysis of OG is this. Government has incentives to do this well. More people and more infrastructure is built, so you get jobs, accessibility and shit for vulnerable people. The problem with this claim is simple. They presume that government is the only way you are able to get any sort of economic output. Because OP can very easily come out and say capitalism works on the idea of free markets, you don't need government. So where does our extension come into place into resolving this? We show you specifically why private companies are inherently taking risky decisions and why in this specific context the government has a better ability to decide what needs to be done. In the sense that government not only needs a lot of these capitals because of the significant amount of undertaking and expenditure they have been taking, but secondarily, this is what specifically they are able to target and resolve in terms of the deficiencies that are created within the market in a large amount of about post-backlash of COVID and things like that. But thirdly, Sharon also tells you why inherently risky decisions that are of large-scale consequences can be significantly avoided. What does this look like? Notice that what actually happens when markets are unstable, right? Capital is very wavy and moving in the sense that nobody knows where to go right now. In the sense that in case you fail or in case there are signals or messages of you in failing, capital is very easy and very quick to fly away. This is why on our side, which Sharon explains to you, where we're less likely to get a Byju's or less likely to opt into a startup that's like a CC rated or really bad rated, on our side, since banks have significantly less capital to give away, they're likely to do things like do more background checks, do more market research and give more less loans.
hurts from CEO's knifing because both of them are contrary frames, but the logical plan of CEO impact is my explanation about how bonds are likely going to be illiquid and you risk a bank run. CG bonds banks to play safe, but you never
15.
which we heavily met with it.
15. So it's right, he's right. CEO completely knives opening opposition. CEO tries to say why there's going to be a cash crunch. Opening of course analyzes why banks are going to give everyone money. We are the only one that brings in the nuanced extension of why specifically you need to be able to do these things. I'm so happy all wants to fuck each other up. Let's move into and specifically on why specifically we will both clashes one day, why this is the most important thing in the debate. Note that inherently CEO's extension is insufficient to win this debate for a couple of reasons. That is to say that if your claim is that guys, nobody's ever going to invest money or nobody's ever going to go to a bank and give money if you have equity accounts. If you're going to say that banks are just so crazy or banks are like that, it's so problematic because all of these things are needed for essential functioning and recovery in the first place. That is to say, CEO and CEO never analyzes what are the specific actions that are needed for you to be able to take place in the first place. They analyze in an abstract in the sense of everything is going to go bad. This is why you need nuance and this is why you need extent. Lastly, a couple of notes on why we are making specifically better decisions and why it needed to help. Look, in order for you to recover from a recession, not only do you need to ensure capital guarantees, which are fun in the first class, but secondarily, you need to build up a certain amount of disposable income, winning on Gov's metrics and opening oppositions metric. In the sense that when we are able to show these people, when they're able to go in and deposit and have not be able to at risk of banker cash crushes, in the sense that even in the worst case on both sides of the house, on our side of the house, you're more likely to be able to actually withdraw your money than on their side of the house when you have a normal account and your money actually vanishes because it got invested elsewhere. For all those reasons, proud to
Two quick thanks first to Harsh. I know it's been a hard couple of months. You're a champion. Great keeping up with you. And secondly, a bit of a self-promotion. I'm convening the Princeton IB. We need judges. Please judge for us and apply for IA subsidy. We really, really want it.
You need the subsidy drafted.
I want to begin by asking a very simple question. No team or anybody in the audience cannot name a single country that has prospered just on the backs of governments and government investment alone. Whether that was India in the 1980s, where Rajiv Gandhi finally realized that it was time to let go of socialism and protectionism and increase privatization, that was only furthered by the 1991 reform. Whether that was even countries like South Korea, where Chaebols, for example, were big industrialists and manufacturers that propelled the country forward. It is just categorically true that countries need private investment. Harsh's extension that gets no response explains to you why governments getting more money on net is actually a bad thing which crowds out private investment. That's the first thing I want to weigh. But even before that, I just want to quickly explain why we don't knife our opening opposition. What does opening opposition say? They say that banks are evil and that people are irrational. I just want to note that what we do is that we take a higher burden than opening opposition. The debating display by opening opposition is weak debating, where they never really contest with the frame that we get from opening government. This is a very real possibility where banks are likely to face a credit crunch. But moreover, I think they give a characterization of people buying into everything. Opening government responds to this, where Chinmay comes up and Rohan, for example, also POIs, where, for example, if the average person doesn't know anything about banks to begin with, they are just unlikely to, for example, go to the bank or have access to it. But furthermore, even if you don't have access to the complex finance nuances that frankly nobody else in this debate also has access to, you will still know, for example, whether or not this is something that is useful for you, whether in the present this loan is something that you need or not. So I think just because people are rational, but also because we take a higher burden than opening opposition, I don't think we knife them at all. Let's talk about government spending and compare it to private investment, which is the first thing. Then I'll talk about risk. dealing with OG and CG. First on government spending. The argument that we get from opening government is that governments getting more money is good, and CG also expands on this, but note that they don't give reasons for why government spending, like the government spending this money is good or not. They just give generic reasons which say that the economy is shit because of COVID. So why is government spending particularly bad? OG says that governments have incentives to come back in power and therefore they will spend it on good ways. I have a few responses to this. Firstly, they never answer the question of where governments are likely to spend this money. It is likely to be, for example, in swing states where near an election, these are the states that you need the votes of. You, for example, don't need the votes of everybody in your constituency or everybody in your district. You just need the majority of the votes. But secondly, they can invest in things like more urban areas, systematically crowding out the poor. For example, people who live in the fringes of cities or in rural areas. Why is this the case? Because this is not a demographic that is politically very active for three reasons. First, they often don't vote because they're daily wage workers. They cannot take the day off work. For many people, the trade-off becomes standing in line in the booth for 3 hours, or for example, putting food on the table for their family. Secondly, they are often politically disenfranchised. Because of historical disenfranchisement, minorities often don't turn out to vote in the present. But third, they are structurally disadvantaged, and this is how you use the term structural. They are structurally disadvantaged in terms of, for example, zoning laws, which basically crowd them out from being politically popular and being politically prominent. This just means that the kind of spending they had was actively worse. But secondly, we told you that the investments that government does are inherently short-termist. So they focus on things like short-term cash transfers near an election, because this is something that is likely to win you an election. For example, an infrastructure project, building a new railway station that takes 10 to 15 years, OG never mechanizes to you why governments have the incentive to do this, because they might be voted out in the next 5 years. They don't really have so. But even if this was not about incentives, this was about capacity